Is the world economy finally healing, or are we simply standing in the eye of a devastating storm that is preparing to wash away the unprepared? We are currently witnessing a global economic landscape that is a study in absolute contrasts, a paradox where record-breaking technology earnings and a surge in consumer spending are clashing directly with the quiet, calculated defensive maneuvers of the world's most powerful institutional investors. This is the inflection point of our generation. Hello, this is Warm Insight. Today, we are going to talk about the tech-led resurgence meeting, a massive correction warning. Leaving a like and subscribing is a huge help to us. To understand why the reports of an Iran peace deal have sent shockwaves through the market, causing oil prices to slide and equities to jump, we must look back at the historical shadow of 1973. During the October War of that year, the world learned exactly how fragile the global engine is. When energy becomes a geopolitical weapon, when the OPEC nations announced an oil embargo, the cost of a barrel quadrupled almost overnight, leading to a decade of stagflation that crippled the Western world. It was a moment where the geopolitical board was flipped, and the global economy spent years picking up the pieces. Today, the mere whisper of de-escalation in the Middle East acts as a reverse of that 1973 trauma. Investors are pricing in a world where the energy bottleneck is removed, allowing the machine of capitalism to run without the friction of soaring fuel costs. When we see the markets jump today, we are seeing a collective sigh of relief that mirrors the end of the 1970s energy crisis, a hope that we are avoiding a repeat of history's most painful inflationary chapters. This reaction is deeply rooted in the psychological phenomenon known as the relief rally, which is often powered by the availability heuristic. Our brains are hardwired to prioritize recent vivid memories of pain. After years of high energy prices and supply chain fears, any news of peace feels like a massive weight being lifted. However, this often leads to a dangerous cognitive bias, where we overvalue the positive news and ignore the structural inflation that remains. It is the same psychological mechanism that drove the markets upward during the brief interludes of calm during the Napoleonic Wars, or the early days of the Cold War. We desperately want to believe the crisis is over, so we bid up prices on the first sign of a ceasefire, often ignoring the fact that the underlying economic tensions haven't actually been resolved. Think of the global energy market like a massive, high-pressure steam engine that powers a giant factory. For years, the pressure gauge has been in the red zone, and everyone in the factory has been terrified that the boiler might explode. Suddenly, someone opens a small release valve. The loud hissing sound of escaping steam is scary, but the pressure on the gauge starts to drop. Everyone in the factory starts cheering and working faster, because they think the danger is gone. But just because the pressure is dropping doesn't mean the fire under the boiler has been put out. The peace deal is the release valve, but the heat of inflation is still burning underneath, and if we aren't careful, the pressure will just build right back up again. As we move from the geopolitical arena into the heart of the digital revolution, we find ourselves in the midst of a semiconductor surge, led by giants like AMD and Intel. To understand the gravity of this moment, we have to compare it to the second industrial revolution of the late 19th century, specifically the rise of electricity. Just as companies like General Electric and Westinghouse didn't just build products, but provided the fundamental utility that allowed every other industry to exist. Semiconductor companies today are the power plants of the 21st century. During the late 1800s, investors, who understood that electricity would touch every single aspect of human life, were the ones who built lasting dynasties. We are seeing that exact same structural shift today. Semiconductors are no longer just components in a computer. They are the fundamental fabric of global productivity. The surging options activity we see in Micron and Intel is the modern version of the massive capital investments that built the first electrical grids in London and New York. The psychology behind this tech obsession is driven by a concept called technological determinism. It is the belief that because technology is advancing, progress is inevitable and unstoppable. This creates a powerful feedback loop in the human mind. When we see a company like AMD report massive earnings, our brains register it not just as a financial win, but as proof that the future is arriving. This triggers our dopamine systems. The same way, a gambler feels a rush when they see a winning streak. We begin to believe that the old rules of valuation no longer apply. Because the technology is so transformative, This was the exact mental state of the public during the height of the dot-com bubble and the radio mania of the 1920s. We fall in love with the promise of the future, so much that we stop looking at the price tag of the present. You can imagine the semiconductor industry as the manufacturers of the high-speed rails for a new cross-continental railroad. In a gold rush, everyone is focused on the people digging for gold. But the real wealth is made by the people who build the tracks that get the miners to the mountains. Right now, every company in the world is trying to get to the mountain of artificial intelligence. They are all buying tickets and jumping on the train. The semiconductor companies are the ones making the tracks, the engines and the wheels. Even if 100 AI companies failed to find any gold, they still had to pay for the train ride. This is why the tech sector is surging, while other parts of the economy struggle. They own the only way to get to the future, and they are charging a premium for the ride. However, beneath this gleaming surface of technological progress, the economy is showing a strange and bifurcated reality. We see companies like Uber and Disney reporting incredible numbers showing that the average person is still spending money on rides, food delivery, and theme park vacations despite high interest rates. This resilience is a direct parallel to the Roaring '20s. Following the end of World War I and the devastating flu pandemic, there was a global explosion of discretionary spending. People who had been cooped up and lived in fear wanted to experience life at any cost. This created a decade of superficial prosperity where the stock market soared. While the underlying agricultural and industrial sectors were quietly crumbling, the consumer behavior we see today, with people prioritizing experiences over savings, is a modern echo of that era. It is a world where the party is still going strong, but the foundation of the house is beginning to crack. This behavior is driven by what psychologists call hedonic adaptation and the present bias. After the global shocks of the early 2020s, human beings have shifted their priorities. We have a collective desire to seize the day because we no longer trust that the future will be stable. This leads to a situation where consumers will cut back on essential savings before they cut back on their annual vacation or their weekly convenience of food delivery. It is a psychological defense mechanism against the stress of a volatile world. We spend to feel in control of our lives, even if that spending is irrational from a long-term financial perspective. This creates a false sense of security for the markets, as retail investors see the crowded theme, parks and full restaurants, and assume that everything must be fine. Imagine your household budget is like a large water tank. For a long time, the tank was overflowing because of stimulus and savings. Now, there is a massive leak in the bottom of the tank, called inflation, and the water level is dropping fast. But instead of fixing the leak, you decide to use the remaining water to throw a massive pool party. All your neighbors look over the fence and see you splashing around and having a great time, so they think you must be incredibly rich. They don't see the empty space at the bottom of the tank. The consumer resilience we see today is that pool party. It looks great from the outside, but it is being funded by a water supply that is not being replenished. Eventually, the water will run out, and the party will come to a very sudden and very dry end. This brings us to the most critical part of the current economic puzzle, the behavior of the smart money. While the general public is focused on the tech rally and the consumer party, legendary investors like Apollo CEO Mark Rowan are battening down the hatches. This is a classic example of the contrarian mindset that defined the great survivors of financial history. Think of the 1929 crash. While the public was buying stocks on margin, savvy players like Joseph Kennedy were exiting the market because they realized that when the shoeshine boy is giving stock tips, there is no one left to buy. Rowan's warning of a correction and his shift toward defensive positioning is a signal that the professionals believe the current valuations have become disconnected from reality. They are looking at the egregious practices in rival sectors and seeing the same systemic rot that led to the 2008 financial crisis. The psychology at play here is a battle between loss, aversion, and the fear of missing out. The retail investor is dominated by FOMO, the terrifying feeling that everyone else is getting rich, while they sit on the sidelines. This drives them to buy at the top. The institutional investor, however, is driven by a sophisticated version of loss aversion. They would rather miss out on the last 10% of a rally than be caught in the first 50% of a crash. They understand that capital preservation is the only way to win the long game. This creates a massive psychological divide in the market. One group is playing to win big right now, while the other group is playing to ensure they don't lose everything tomorrow. It is a clash between the impulsive amygdala of the crowd and the calculating prefrontal cortex of the elite. Think of the market like a massive game of musical chairs being played in a giant ballroom. The music is the tech earnings and the geopolitical news, and it is playing louder and faster than ever. Everyone is dancing and having a blast, but the smart money players are the ones who have noticed that every few minutes, the host of the party is quietly removing 10 chairs from the room. The dancers are so distracted by the loud music that they haven't noticed. There are now 500 people and only 50 chairs left. The institutional investors are already standing right next to a chair, ready to sit down the second the music stops. They aren't dancing anymore. They are just waiting. The retail investors are still in the middle of the room, doing backflips and showing off completely, unaware that the game is about to end. So, how do we navigate this bifurcated world, where the bulls and the bears both seem to have a valid case? The answer lies in the survival mechanics of the barbell strategy and dollar-cost averaging. This is not a new concept. In fact, it is how the greatest merchant, families of the Renaissance, survived for centuries. They would keep half of their wealth in incredibly safe, boring assets, like land and gold, while using the other half for high-risk, high-reward maritime trade. They didn't try to predict which ship would sink. They just made sure that if one did, it wouldn't ruin the family. This is the exact approach needed for the 2026 inflection point. You maintain exposure to the growth of the future, like technology and semiconductors, but you balance it with a heavy shield of defensive assets and cash. This strategy leverages the psychological concept of anti-fragility. Instead of trying to be right about the future, you build a system that can benefit from volatility. Most people have a fragile mindset. If the market goes up, they are happy. If it goes down, they are devastated. An anti-fragile mindset acknowledges that we cannot know the future. By using dollar-cost averaging, you remove the psychological pain of timing the market. You become a machine that buys more when things are cheap and less when things are expensive. This neutralizes the emotional roller coaster of greed and fear, allowing you to remain disciplined while everyone else is panicking. Imagine you are a professional athlete training for a championship. You don't just spend all your time practicing your most dangerous and exciting moves. If you did that, you would eventually get injured and be out of the game. Instead, you spend half of your time on basic strength and conditioning, making your body resilient and tough. The other half of your time is spent on your high-level skills. The strength training is your defensive assets, the cash and the safe bonds that keep you in the game. The skill training is your tech stocks and high-growth investments. If you only do the exciting stuff, you are fragile. If you do both, you are a champion who can handle any hit the opponent throws at you and still come out on top. The global economy is currently a study in contrasts, primarily shaped by evolving geopolitical dynamics and persistent inflationary pressures. While the prospect of lower energy prices offers some relief, the sticky nature of core inflation continues to dictate the trajectory of interest rates. We are seeing a profound transformation, driven by technological innovation and surprisingly resilient consumer behavior. The ongoing restructuring within sectors like cryptocurrency highlights a broader industry push for efficiency and adaptation to emerging technologies. This digital pivot, coupled with strong earnings from semiconductor giants, underscores the robust health and future potential of the tech sector. Historically, this transition mirrors the period after the introduction of the printing press in Europe. Before the press, information was controlled by a tiny elite. When the technology arrived, it didn't just make books cheaper. It fundamentally restructured how power, religion, and economics worked. It led to the Reformation and the Enlightenment. However, the period of transition was incredibly volatile. There were wars, economic shifts, and massive social unrest. As the old system died and the new one was born, we are in that same kind of transition today. AI and high-speed semiconductors are our printing press. They are making the old ways of doing business obsolete. But the birth of the new system is causing massive friction in the global economy. The psychology of this transition is one of profound uncertainty. Human beings hate uncertainty more than they hate bad news. When we don't know what the rules of the new world will be, we tend to cling to the old ones or swing wildly between extreme optimism and extreme pessimism. This is why the market sentiment is so bifurcated right now. Half of the world is looking at the new technology and seeing a utopia where everything is free and easy. The other half is looking at the rising debt and systemic risks and seeing a collapse. Both are reacting to the same uncertainty. The key to surviving this psychologically is to accept that the old world is gone and to focus on the fundamental values that have always created wealth, innovation, and human progress. Think of the economy like a massive forest that hasn't had a fire in 50 years. The trees are huge and beautiful, but the ground is covered in dead wood and dry leaves. This dead wood is the egregious practices and systemic risks that Mark Rowan is worried about. The tech resurgence is like a new species of incredibly fast, growing trees that are trying to take over the forest. They are beautiful and strong, but they are growing in the middle of all that dry tinder. A market correction is like a forest fire. It is scary and destructive, but it is also the only way to clear out the dead wood, so the new trees have room to grow. The wise investor isn't someone who tries to stop the fire, but someone who makes sure their own house is built out of stone and has a clear space around it, so the fire can't reach them.